I'm Pamela Hastings, Relationship Manager at Barometer Capital, and welcome to another Barometer webinar. Today, as always, we will provide you with a brief macro overview and provide you with an opportunity to ask our Chief Investment Strategist and President, David Burrows, some questions at the tail end of his commentary. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Q&A or the chat via Zoom. And with that, I turn the conversation over to David Burrows. Good afternoon, David. Looking forward to our webcast today.
Thanks, Pamela. Well, just like clockwork, I restarted my computer just before the webcast started, and PowerPoint decided that that was the moment they had to download a new version. So I apologize for being a little bit late today. Anyway, ultimately got it done, and we got lots to talk about. I'm starting to like doing these webinars on Tuesday because as the term goes, we've had a lot of turnaround Tuesdays over the last number of weeks. Today was a particularly strong day, especially in our themes. So we're going to talk a little bit about what's going on, what's happening internally in the market. We've talked for some time about the fact that, especially in an election year, you often set up a pretty good fall, and in fact tends to be for a fourth quarter and a first quarter tend to be quite strong in the following year. That seems to be working its way out at this point. Certainly lots of things that people are worried about, but then we've worried about them for a long time. So market has digested a lot of news. Let's take a look and see what's going on. Just to start from the top, we've had a view that we're in a structural bull market that started in 2013 when we exceeded the 2000 highs. And we've been generally marching our way higher since then with a series of sharp interruptions like 2015-16 and 2018, but they've been bull market corrections, very different than the ones like the tech bubble burst in 2000 or the financial crisis 2007-8 or the meltdown driven by inflation and an energy shortage in 1974. Quite a different picture. So a baseline is we're in a structural bull market, and when we look at the last two structural bull markets, the 1980s and 90s, and the period after 2013, you can see we've been lower bound by the 200-week moving average while we've remained in a structural bull market, and that continues to be the case. It's really important, and I point this out over and over and over again. The reason that it's important not to get too bearish is because what comes after the retracement to highs and then the move to the next major correction is very substantial. In this case, in 2018, you were back to new highs in 3 months. In the case of 2015-16, it was a little bit longer exercise. It was not as deep a drawdown. So it's a measure of time and price that you get in the course of a correction. If you look at the 1990-91 recession, it was a substantial recession. The drawdown was about 13%, really not so deep, but it went on over the course of a year and a half. Very different than the very sharp bear market that took place in 1987, happened over 3 months, but it was pretty sharp. It was 36%. But again, what came after in each case was very substantial. So important not to get too bearish. And remember, the smartest people in the room are the ones that sound the smartest, are often the most bearish, the most contrarian. But often they wind up being a little bit overzealous. When we look at the fixed income market, we know that we went through a significant shift in 2020 when we saw a generational low in rates. That was our belief. Our belief was it was much like what happened in the late 1940s after the Second World War. And when that took place, rates rose in fits and starts until 1981. So what ensued is, in the course of our investing lives, 40 years of falling rates in fits and starts. And we get used to the things that work in falling rates and have a view that that is going to be a constant for good. And it's not. When you go through these big structural shifts, you have to recognize them and recognize that probably different groups and sectors and themes are going to lead the market and be better places to invest than the things that worked during falling rates. Things get extreme. So we know that this past year, has had the most significant bond bear market going back to the late 1700s. Now, the good news is often you get a bounce coming off of those periods, but it doesn't mean you get sharp returns. The TLT from top to bottom fell 48.35%. The TLT is the 20-plus year Treasury bond ETF in the US. Now, for a generation, people learned to buy dips. This time, it did not work. So there's a whole bunch of people that are trapped, having paid higher prices for bonds and are underwater and are not necessarily bond investors because they believe bonds are the best place to be, but it was one of the highest momentum investments you could make. So these people, in many cases, were renters of this security, not long-term buyers planning to hold them for 20 years, getting a 1-point-some-odd% return. When we look at the 10-year Treasury yield, it fell from 1981 to the lows at around 40 basis points in 2020, has moved up since then. The stock market doesn't much like it when yields move sharply higher. And as a result, we had a good corrective period in stocks. We got to a high of 4.4% on a 10-year. Since then, it's pulled back a little bit, 3.75%. So bonds have rallied a little. That's taken some pressure off of stocks. But just because bonds have pulled back a little in yield doesn't mean now we're headed back to low levels. We know that often it can go on for a long time. If we look at the last time we got into rising rates, late in the 1940s, 1947, 48, you had 2 years of sharp inflation driven by supply chain issues, where demand from people coming back from the war couldn't be sustained with supply. So what happened? You had a difficult bond period. 1947, you had a 1% return in bonds, and stocks had only a 5% return. 1948, stocks had a 5% return, bonds were 2%. Now going forward, look what happened. 49, 4.7%, then 0.4, then minus 0.3, then 2.3, then 4.1, 3.3, minus 1.3, minus 2. Subpar returns for 10-year bonds for the next decade. On the other side, what happened? Once inflation started coming down, stocks took off. 1949, 18%, 1950, 31%, 1951, 24%, 1952, 18%, corrective year in 53. 52% in 1954, 32% in 1955. That was a reflationary period. Rates were rising. It doesn't mean that inflation killed the stock market for the next 10 years. In fact, very different than that. But the things that worked during that period were largely things that worked during rising rates. One of the most important themes was dividend growth. So here we are looking at long-term relative performance of commodities versus the S&P. We know that commodities, when they start to outperform or rise relative to the S&P, it often goes on for a long time. So we've made the case that in 2020, we saw a secular low for commodity prices, an extremely unpopular sector to invest in because it had underperformed stocks since 2008. It's a long time to go through underperformance, and that would shake almost anybody's confidence. But now we've got a different picture. Commodities broke out of their long-term downtrend in beginning of 2021. And despite calls for a hard landing recession, they have outperformed stocks steadily ever since. In fact, the recent high in commodities was in June, as the stock market was making lows, pulled back for a couple of months, and now once again firming. If we try to understand why, it's because during a bear market, eventually companies stop spending money on new capacity. Board of directors say, you're not going to blow all of our cash. And they hold on to the cash, and new investment falls. It becomes hard to raise money in the stock market to grow. It gets hard to get debt. And here we are in 2022, and we are sitting at least a decade low in capital spending in this sector. So we know we have structural shortages, low inventories, in many cases, 10-year lows in inventories for things like metals and energy. And you don't have any spending taking place to replace it. It takes a long time to put a copper mine in place. Okay, now let's talk about real estate. This is something that gets helped by falling rates, generally a highly levered asset or an asset that people buy in as an alternative to a 10-year or 20-year bond if you're a pension fund or insurance company. We can see that the sector continues to be down. It's actually down right now about 30% year to date. And relative to the stock market has been a weak performing asset. If you take real estate developers, probably an even more rate sensitive sector, relative price strength has been falling since 2020, when rates started to rise. And we're sitting now effectively at a relative new low versus the stock market. So I can't tell you how many conversations I've had with people who say the one asset I've never lost money in is real estate. Well, that should be the case if you've had falling interest rates for 40 years. Real estate not in a secular bull market, something right now we want to continue to avoid. Let's talk about currency. We highlighted the fact that 3 weeks ago or 4 weeks ago, a number of covers of business magazines put up testaments to the strength of the US dollar, often a harbinger of something that may be a little worse. We got our first sell signal on the point and figure price chart for the DXY, which is the index of the US dollar versus the basket of world currencies. And that reversed lower about 3 weeks ago. So now let's talk about, we're frozen, there we go. US dollar. So here's US dollar since October, down about 8.2% off the highs. We bounced a little over the last week and then today backed off, but on a relative basis, US dollar has been weakening. So we've had yields come down a little. We've had the dollar back off a little. Both things, when they were rapidly rising, were real pressure on risk assets. And as a result, we've seen a little bit better return to risk assets. Now, our job isn't to be everywhere. We could be in any asset class. We could be in equities, fixed income, real estate, currencies, emerging markets. Our job is to identify the things that have a structural tailwind. Our job is not to be everywhere. We always look for new leadership to emerge, new opportunities, universes within our investing world that we could focus in to find new opportunities. And in the absence of leadership, as you know, we have a willingness to be on the sidelines, whether it's holding cash or just out of big parts of the market. So what we're trying to provide is something that's quite tactical. I recognize there is a view that passive investing, just owning indices, is a lower fee way to go. Our view is there are times you don't want to just be underweight certain things. You don't want to own them at all. So our portfolios tend to be very uncorrelated to the underlying stock market. We use a combination of 3 sets of tools. We use some top-down modeling that helps us take all of the investable universes that we could own to drill down to those that are seeing net inflows of capital. Where is it that money is getting put to work today? Money flows to the asset that treats them the best. When we identify those areas, sectors or themes or geographic regions, we use our security selection work to try to identify specific securities within those groups that are performing just better than the rest, have better fundamental data, earnings, cash flow, fixed debt levels, and so on. And then those that have strong technical factors or price characteristics. So fundamentally strong, technically attractive in groups that people care about. Well, this is where our portfolio should live. Now, the fact is the market changes and a portfolio is supposed to be a living, breathing thing. We have to reevaluate it daily. And one of the third most important things we have to be able to do is be a good seller, because we know at some point every investment needs to be sold. So if 80% of return comes from getting to the right sector and right asset class, that's where our top-down work comes from. The security selection is 20% of return. That's aimed at finding the best securities within those groups. And then the last piece is inventory management, using disciplined selling to take out the positions that don't work and holding the ones that do. So let's talk about the world as it is today. The areas that are seeing expanding breadth. Where is it that more and more money is being put to work, where more and more securities are participating? These are the constructive parts of the market. And then on the other hand, where is there deterioration in breadth or relative underperformance? And these are the groups that we want to try to avoid until we see that start to change. On October 11th, we highlighted that after several months of weakness, we started to see some improvement in our underlying indicators. Specifically, if we took all of the companies in the New York Stock Exchange and quantified what percent of those securities were in uptrends, higher highs and higher lows, that percentage had started to rise. That means breadth is starting to improve, more and more securities acting better. We recognize that across the globe, lots of companies started to trade back above their 50-day moving average or short-term measure of trend. That's improvement. Percent of stocks with positive weekly price momentum or upward trajectory started to increase. So that gave us pause to start to put a little bit of money to work. Now, October was a very good month, up 13% for the Dow. We know that November over the last 10 and 20 years has been a very strong point of the year. So we're open to the fact that despite lots of things to worry about, it may well be that we could get at least a short-term rally. And you can't get a long-term rally without it starting with a short-term rally. As we sit today, things are markedly better. As we sit today, 52% of all the companies in the NYSE are in clearly defined upward price trends, which we define using point and figure price charts. In Canada, about 40% of stocks are in uptrends, and globally, about 42% of stocks are in uptrends. Across the globe, the percentage of stocks trading above their 50-day moving average has moved sharply higher. In the US, over 70% of companies are trading above their 50-day. The percent of stocks with positive weekly price momentum moved as high as 90%. It's backed off a little bit over the course of the week as the market has been sorting good from bad. Percent of stocks making new highs versus new lows has increased sharply. And importantly, the percentage of stocks trading above their long-term moving average, their 150-day moving average, has moved back above 50%. So despite lots of concerns, there is money getting put to work. And it's not our job to say that the market's wrong. It's our job to recognize what is happening and make sure our portfolios are aligned. As it turns out, equity flows on a 4-week moving average have started to improve after weakening all the way through 2021 and 22. So here we are a month and a half from the end of the year. A ton of investment managers and individuals are way behind their benchmarks. They're sitting on lots of cash. They may well still have hedges against a weaker market, which in fact they do. But they're going to have to generate some returns if the market moves higher. And this is what we can see happen when we get a year-end chase. So we'll see, but we continue to see improvement. Here's the S&P, came off the low on October the 4th. We've moved higher since then. We first consolidated in a little pennant, moved higher again. Now we've been in a little flag, and today we came out of the top of that flag. So the next hurdle will be for the S&P to get over the 200-day moving average. Remember that the S&P is made up of lots of different sectors, but the most heavily dominating companies continue to be in one of the weakest performing areas, and that's large cap growth. They have a large impact on the S&P. If we look at the equally weighted S&P, where every company gets an equal vote, it's behaving much better. If we look at volatility, volatility has come back down from near these high levels over the last few months to about the average level of volatility going back over a longer period of time. If we put this back to 2008, we're trading almost right back to a normal level of volatility. So lots of concern around the Fed rate hike cycle, lots of concern about an economic slowdown. But after 18 months of weakness in unprofitable tech and 9 months of a bear market in large cap companies, it may well be that a regular recession has been priced in. So unless we see signs of a hard landing, it may be that we've seen what is typically an 18 to 28% pullback in stocks, the signal of recession during a bull market. We got to 27% in the S&P. So one of the major concerns for stocks has been the supply chain. And certainly what's going on with the Fed and what's going on in the economy appears to be starting to settle some of those issues. Manufacturing delivery times have come down sharply. Shipping costs have come down sharply. Expected orders in backlog are way lower. Raw materials inventories were at very low levels, have come back to more normal levels. And vendor lead times have come sharply lower. The market is sensing that we may have seen peak inflation. Let's talk about market leadership. In October the 11th, almost all of the sectors that we track, 42 of them, were seeing deteriorating breadth. All of the sectors that are in small letters or lowercase were showing deteriorating breadth. All of the sectors in this column had only between 16 and 20% of the companies within their sector, as measured by a point and figure chart, in uptrends, meaning over 80% of the companies in these groups were in downtrends. The few that turned higher first, energy, well, that makes sense, been leading all year, oil service, transportation, builders, Wall Street, machinery, all quite cyclical sectors. Now important because those are sectors that had been leading going into the downturn. Remember, growth stocks turned down first, and then the more cyclical sectors got hit in the spring of the year. If we look at where we sit today, as of the 21st of November, almost every sector is in capital letters, meaning we're seeing expansion in breadth. We did this week see some pullback in energy. In fact, it really appears to have been something that was short-lived. There was news that the Saudis may look at increasing their production. Oil briefly dropped to $75 and then quickly back above 80. Oil stocks regained their strength. But in the process, remember, this is all about having process. When breadth turned lower for energy, we took down our energy exposure just a little because that's a deterioration in breadth. But the sectors have been moving higher, and you can see this group here, steel, semiconductors, banks, and machinery, have between 60 and 62% of companies in uptrends. It's broadening. So the strength in the market is broadening across individual companies and across sectors. Let's look at the leadership groups. Energy, the IYE, iShares US Energy Index, trading at a 96 relative strength. Relative strength has been rising all year long, and we're trading effectively at highs of 65% as a group since the beginning of the year. Now, when energy starts to outperform the S&P, it tends to go on for a long time, and this is very early days. Again, very low CapEx since 2014, and CapEx is slow to come back. The energy services sector, though, is outperforming along with the producers. You can see rising relative strength, a 96 out of 100 relative strength, meaning that the OIH, or the Oil Services ETF, is trading stronger than 96% of the companies in the S&P 500. And here we are very close to breaking out to a new high. So energy and oil, strength in energy continues. Financials, relative strength rising since July. We're just about to take out the highs from August, and across the groups, they continue to be strong. Last week, we talked about the investment banks and capital markets, which continue to be very strong. And we highlighted the fact that the large banks, while they were seeing strength over the last few months, more importantly, are still just coming out of a consolidation that took place since 2008. When we come out of one of those long consolidations, it often marks the signal of a beginning of a new secular bull market. Now, our largest position in US banks is JP Morgan, and the leader should break out to new highs earlier than the rest. You can see JP Morgan broke out to a new high in 2015, 5 years ahead of the group, and has moved higher in fits and starts since. You can see that the earnings line has continued to improve. These are the earnings forecasts going forward by groups of investment dealers. And you can also see that relative strength is improving. So the leader should lead and continue to lead. And certainly we're seeing that in JP Morgan. Insurance, we talked about insurance earlier in the spring. Relative price strength for the insurance sector performing well. This is largely made up of property and casualty companies. Our top pick in the group has been Progressive. We talked about that a couple of weeks ago. We made a new all-time high today, trading better than 93% of the companies in the S&P. And it just turns out that Progressive has just run better than virtually every other property casualty company. Large part of their franchise is auto. They have great intelligence in their pricing models. Their dynamic pricing models. A lot of the people who buy their insurance have monitors inside their cars that monitor their driving records, and as a result, they're extremely competitive. But that's great performance in a very tough market. Talk about industrials. Industrials continue their very sharp rally. We know that when the market was making its lows in June, relative strength had pulled back a little bit. When the market retested the lows in October, relative strength was higher. We were looking for groups of securities that performed better in the second test of the lows, being October versus June, because that shows relative strength. And when you get that, you very often get a very sharp retracement. And look, the VIS has moved from 156 to 188 in the course of about 3 weeks. And that's made up of a couple of groups, aerospace and defense, which we talked about, things like General Dynamics and Lockheed Martin and Northrop Grumman. But it also is made up of the machinery companies. Look at Caterpillar closing out on a new all-time high and a new relative strength high, going all the way back to 2018. The group that we haven't talked so much about are the rails. And when energy prices are high, the rails are much more competitive. CP happens to have a dominant position shipping commodities. We know commodities have been very strong. And again, relative strength has been improving all year long. So there are pockets of strength in this market, and they include sectors that are very economically sensitive. Financials, Wall Street firms, insurance, rails, energy, materials. Materials, again, making a new relative high versus the market since June. Relative strength has started rising in November of 2020. This is made up of steel companies, miners, the XME, after going through a consolidation phase from 2014 through 2021, has reignited, and we're making new relative highs from March of this year, but relative strength started higher in March of 2020. These are groups that did not perform well during falling rates. These are groups that are underowned. These are groups that are relatively small portions of the S&P, but generating outsized returns. Even gold, we talked about last week, having broken out of a multi-month pullback into support. And when we look at some of the holdings that we have, Franco-Nevada would be our largest. It's a dividend payer. It's a royalty company. Again, relative strength rising sharply and moving back toward all-time highs. Steel, very unpopular group. Went through a long bear market from 2012 through 2021, reigniting and moving sharply higher. But the leaders, things like Nucor and Steel Dynamics, are making new all-time highs. And again, when we come out of a long period of consolidation, it often marks the beginning of a new bull market. So I understand the comments that it may be that the Fed could be too aggressive and force a recession. The market isn't telling us this. The market is telling us that the most attractive parts to be invested in are those that are most economically sensitive and those that are helped by a reflationary environment. If we take the dividend-paying resource companies, things like Exxon and BHP and Rio Tinto, this is an ETF, the GUNR, pays a 4.4% dividend and is growing its dividend at about 11%, moving sharply higher. Okay, on the defensive side of things, there are a couple of sectors that have continued to perform well, that are very consistent performers, that have underperformed over a long period of time, but now performing well. The XLV is the broad-based healthcare ETF. The biggest holdings in here would be United Healthcare, it's a healthcare provider, J&J, Eli Lilly, and Pfizer, a lot of the pharmaceutical companies. We've talked about biotech last week, nicely rising relative strength through the course of the year. This week, we'll talk a little bit about pharma. Merck, one of our biggest holdings, Lilly would be the second. Look at this blast off in Merck. And that's impressive. Although sometimes you have to pull the lens back, because when you pull the lens back, we see that Merck is just exceeding the previous high in 2001. So it's been through a 20-year walkabout while the company built its underlying strength, and now breaking out to new high is a 2.6% yielder. So two themes, reflationary themes and defensives. Consumer staples fit that bill as well. Infrastructure fits that bill as well. Rising relative strength, new relative strength high, going back about a decade. So that second theme, and in fact, the first theme, all feeds together. It's dividend growth. We've talked now for 2 years. When rates start to rise, the most important characteristic is to have a rising stream of cash flows. You need a rising stream of income to offset inflation or rising rates. This is the FDL, Morningstar Dividend Leaders. It's had rising relative strength since 2020. It's very close to making a new high, and it's made up of energy, healthcare, materials, transportation, financials. These are the things that we're talking about. 3.6% yielder, and the dividend growth has been roughly 7% over the last 5 years. The second common theme with all of these is value. It's not growth. Again, these companies, United Healthcare, Berkshire, J&J, ExxonMobil, JP Morgan, Eli Lilly, Chevron, Pfizer, Staples, PepsiCo, and Coca-Cola. Sectors that have underperformed for a long time. Now let's look at the other cohort. IGM is the iShares Tech Select ETF. Relative strength's been falling since November of 2020, showing no signs of reversing. We look at the communications group, companies like Meta and Google. Relative strength continues to weaken, but they are the largest companies in the market. Within this group, it does include some phone companies, and we do own T-Mobile and we do own Iridium, both of them growing well in excess of their peers, both of them making new highs. The Vanguard Growth ETF making no move to regain relative price performance, so nothing to do here. And when we put it all together, since the US dollar started pulling back on September the 27th, once again, the strongest groups: energy, materials, industrials, financials, healthcare. The S&P and Staples coming in right in behind. So it's really important that we have a process to make sure that the holdings we have across the firm are in line with what's going on in the market. Where are the flows going? Our biggest weights continue to be energy, which is a very significant overweight, although we did pull it back a little bit this week. Financials, industrials. Healthcare is an underweight, but it's been a rising position for us. And materials is close to a triple weight, the index. We have a small amount of dry powder, 7% in government bonds. Largely, though, that's in our balance mandate that is mandated to have 25% of its exposure in fixed income. That's all short-term fixed income. Communication services is still an underweight, but we have two large positions there, Iridium and T-Mobile. Consumer staples is about market weight, but from an underweight perspective, very little by way of tech. We own IBM, which is actually very close to making new highs and one of the best performing tech companies, and Advanced Micro Devices. Consumer discretionary is about a third of the sector weight. And the largest holdings would be company like O'Reilly Auto Parts. As people are maybe putting off buying a new car, auto parts are doing very, very well. We have a 4% cash weight. We have almost nothing in utilities and real estate. So it looks to us like we continue to be aligned. It looks to us as though market conditions continue to slowly improve. Outside of the US, there are some outperformers. We talked a little bit about Japanese equities. Japanese equities currency hedge, this is a DXJ, today had a very significant breakout to new highs. We think that's really positive. We're also seeing strength in India and Mexico. So I get it. As we sit this week, bullish sentiment in the AAII sentiment survey is at a low not seen since the late 1980s. People are nervous. Bearish sentiment, on the other hand, is very high. We haven't seen that since the financial crisis. We know that hedge funds have exceedingly low equity exposure. So positioning and sentiment is extremely defensive. And you might expect that after all of the things that we've been worrying about. But keep this in mind. This is what's happened across asset classes this year. It's been a horrible year for almost anything except for commodities. And we've been a bit of a lone voice on commodities. When we look around the world, the vast majority of countries have had horrible equity returns for this year. But keep this in mind. When we take all of the years where the Wilshire 5000 or the broadest base US equity index had the worst 9-month periods, which this year led up to the end of September, down 25.9%. What tends to come forward are strong returns. So we recognize there are concerns. We watch for signs that they are impacting the groups that we're focused in. We recognize that the news flow is a little scary, but it's really important that we are invested as things start to improve after these bull market corrections. So we don't know what will happen next. We'll watch every day. If we start to see deterioration in our breadth models at the market level or the sector level, if we start to see flows move away, if we see the data getting worse, volatility or credit spreads, we're very happy to get defensive. But I would say what's more likely is that 1 year, 2 years, 3 years, and 4 years from now, we will be at much higher levels, despite the rhetoric that we hear on TV every day. And one more piece. We know what happened after midterm elections since 1950. Every year, the next 6 months was positive. So we'll wait and watch. We can only take this one day at a time. We can only put one foot in front of the other. If things get worse, we'll get more defensive. We're happy with how things are going so far over the course of the year. Not everything is perfect, but in aggregate, we're pleased with the results. And with that, Pam, if you've got any questions, certainly happy to answer them.
Thanks so much, David. Yes, I just have one question here. With the news on FTX, David, has Barometer held a position in cryptocurrency in the last 6 weeks? And what is our thesis on this going forward?
Yeah, so am I no video going? So we did have a small position in Ethereum and just through an ETF. And as it started to back off a couple of weeks ago, we got rid of it. So we have a 0 weight as it stands right now. When things aren't performing, they got to get shot. And it made an attempt at a bottoming process. And it may well be this is that one blow up that has to take place at the end of a bear market. But there's other stuff going on that we can focus on, and I'd prefer to do that.
Thank you so much, David. Robert has a question here. He says, hi, David, can you comment on the lithium miners?
Yeah, so the lithium miners have been a little bit sluggish. I own a little bit of Lithium Americas, LAC, personally. I sort of have it on the 1 yard line, the LIT ETF we held in our macro portfolio. And just given the fact that some other groups have been relatively stronger, it was a small weight, about 2.5%. We've let it go. I can see why it is that it should do well, but the market's not giving me that message right now. So it's got to prove it. It may well be that it can get going if the rest of the materials are strong. I think that part of the weakness has been related to the weakness in Tesla shares, and the association with those growth stocks. So we'll have to see. I think that fundamentally it looks like they're going to need to produce a lot of lithium if we're going to produce all these electric cars. So I certainly keep it on the screen and I'm watching it every day. But at this point, I'd like to see some relative price performance before I'd add more exposure.
Thanks, Dave. Next question comes from Harry. He wants to know how you would compare Canadian to US oil stocks.
Great question. It depends on what you're looking at, whether we're looking at gas or oil producers. As you know, we have transportation issues in Canada, and as a result, some of the Western Canadian pricing is very weak. Certainly, right now there's a big differential for light oil versus heavy oil. But we own a broad cross section. You know, we do own CNQ. Even though the pricing on heavy oil is a bit weak right now. The gas prices are a little weaker, obviously, in Canada, but we own tourmaline. We own Vermilion, you know, which is getting a bunch of revenue out of Europe. And then we own the big guys like ExxonMobil and Hess. The whole group has a tailwind. And so we have broad-based exposure. We have exposure to energy services through precision drilling. We have secure energy. We have exposure to energy infrastructure in our macro portfolio in the AMLP, which is made up of midstream energy pipelines that are yielders. We own, I believe, Pembina Pipe in Canada. So it's one of those things when a group gets into a real leadership position, we start with some small positions and then we build them. And as you can see, we're close to 20% of our overall firm assets in energy. And it doesn't mean it's all oil producers. It means it's various companies that are associated with energy in a lot of different ways, but we don't get there until, you know, there's a real strong theme in place. And I think it's great that we're seeing other sectors broaden out and improve. There's things that we can diversify with, but you have to remember that the group that doubles first in a bull market often is the group that doubles again first before anything else. So strength begets strength, especially when it's a group that went down 90% in the course of a structural bear market and has repaired over a period of months and looks as though it's ready to work its way higher for a sustained period. So we'll keep watching it day by day, but that's sort of our approach.
Thanks so much, Dave. Last question here. Bob wants to know if Barometer generally favors the US, Canada, or international equities over the next couple of years.
You know, that's a really good question. Through the course of this year, we have had a much heavier exposure to Canada than we have had in years. Now, knowing that Canada has underperformed as a market since 2014, roughly the period of time where energy had its bear market and commodities had its bear market, that would make sense. With strength in basic materials and energy, that is helpful to the Canadian market because from a sector makeup standpoint, we got a much heavier exposure in energy and materials. Our banks, of course, are exposed to those things as well. So we really favor Canada right now. We also have in our global macro portfolio exposure to South America through Brazil and Mexico. Haven't owned those for a long time. And we have exposure to Japan, a 5% weight exposure to Japan. And I bet there's not too many people who have a significant exposure to Japan after 40 years of a bear market. So I think it's very possible that the US stock market will underperform global markets for some period of time. It's so heavily dominated by large cap growth stocks and everybody owns them. There's nobody out there that didn't think, oh, now it's time to buy Google or Apple or Netflix. So my guess is that the S&P is likely to underperform other global markets for some time. And that's why it's probably a really good time to be an active manager because you can pick your spots and look different than the market and not lug some of the underperforming assets.
Thank you so much, David. As always, we appreciate your time. And I know that our viewers always appreciate your perspective. So appreciate that. And with that, I will leave you with the final word and look forward to seeing you next week.
Great. Well, forget me. We appreciate you guys joining. This is it's something we've been doing weekly now since the beginning of the pandemic, and and I don't think that we'll ever stop. If there's stuff that we haven't covered that you've got questions about, please let us know. If there's stuff you'd like to talk about offline, I'm happy to jump on the phone. We have pretty close relationships with our clients, but we only have about 300 families that we take care of. And if you've got questions, we'd be happy to talk to you. So don't hesitate to give us a call or drop us an email. And otherwise, we'll see you again next week, next Tuesday. Thanks, Pam, for coming on and moderating.
Always a pleasure. Bye, everyone.